Well, here we are, Chapter 6. We have 3 chapters in a row here where we're going to be talking about common stocks. So this initial chapter will just give us a little overview of the stocks and the stock market itself. What is a stock? I mean, the people that purchase stocks, obviously the owners of a company, the stockholders, are frequently referred to as residual owners. Essentially, if anything is left off after the company pays all of its bills, after it pays its debts, if there's anything left over, the residual, that's what goes to the owners of the company. So, what is the appeal? Since you have to stand last in line, what is the appeal to investing in stocks? It allows you to tailor your investments. There's a variety of choices and options, different strategies that you can play. Through dividends, there's good current income for most companies. They're very consistent with their dividend payouts. And also, stocks can increase value over time. If you kind of look at what's happened to stocks over the last several years, you can find it at different parts of time, right? Dividends are usually fairly consistent. The rate of dividends that are paid. It's the capital gains that changes the most. But you can also see that over time, there are certain time periods where you make a pretty good return with stocks and sometimes not so much. Where I like to focus really is the long haul. And this goes from 1950 to 2010. And what you can see here is that on average through this time period, over the 60 years, you made about 11% when you're investing in stocks. 3.6% of it is dividends, and the other 7.2% is capital gains. So how do stocks change relative to the housing market? And this is really something that is kind of near and dear to our heart. If you own a home lately, you know that there has been a housing crisis. So what happened to the stock market and housing prices, and how do they seem to relate? And as you can see here, the red line is the stock market, and it was moving along fairly well with the price index on housing, and then it dropped dramatically. When it dropped dramatically, it was doing it at the exact same time as the housing market is. Now, what's not necessarily predictable, I guess, is that the stock market has recovered fairly well, but yet the housing index has not. So housing hasn't come back yet. It's slower to rise and come back to its older place, where the stock market has obviously recovered fairly nicely, at least up until the last couple of weeks. Stock returns, again, we've talked about this. They range anywhere from 15.3 to 2.7%. As I mentioned, the big returns are actually coming from capital gains. That's where the big movement is in stocks. They generally earn positive returns over the long period. Again, we talked about this 11% over the 60 years. However, obviously it was not without risk. You can see that there was actually a 10-year period where the net marketplace lost 1%. So again, it is the idea is here that stocks make money. If you're in it for the long haul, stocks are a great investment. They can make some decent returns, but you have to be in for the long haul. So what is a bear market? A bear market is where you have a routine decline, right? This is especially if it's a drop of 5% or more of one of the major indexes. So if the Dow Jones would drop by 5%, we would say that is a routine decline, that the market goes up and down plus or minus 5%. In a bear or bull market, it really doesn't matter what you're talking about, but it's the 5%. When we get a 10% decline in market or more, right? We're talking about a correction. The market is making a move in another direction. And again, a bear market would obviously be down, a bull market would be up. And if we actually are in what we refer to as a bear market, there would be a drop of 20% or more. And again, if you look at the stock market, I mean, this is obviously 2016, it's January. There has been a substantial decline in the market over the last couple days. So we were up in the 17,000s. The other day I looked and we were actually down at 15,000. So we've dropped about 2,000 points out of 17,000. So that's a fairly significant drop. How long that will stay or why that happened, again, everybody is trying to figure that out. But there's lots of reasons why the markets sell off or don't sell off. Most of the reasoning right now has to do with Asian markets are doing very poorly, and that carries over into our market. Also, oil prices at our all-time lows. Essentially, why is that bad for us as consumers? That's really not bad for us. But a major component of the stock market are the oil companies. And obviously, the oil companies are taking some major hits to profits because of the declining prices. So what are the advantages of owning stocks? Get higher opportunity for higher returns. You can obviously double your returns from what you can get with bonds. They're a good inflation hedge. Typically, they're going to beat the risk-free rate of return over the long haul. It's easy to buy and sell, data is easy to find, and the cost per share at least for some stocks is fairly low. So we have some advantages to actually being able to get into the stock market. The disadvantages are all the risks. There's a variety of risks depending on what kind of investment you want to get into. It's pretty hard to predict which way stocks are going to go. They obviously have at times some fairly wide swings. They are fairly volatile, if you will. And with return to some other kinds of investments, they have some rather low current income. Again, the current income piece is dividends. The dividend payout is typically fairly low compared to the capital gains piece. So your actual cash inflow on an annual basis is typically lower for stocks than it is for some other investments. So how does the dividend yield and the coupon yield relate with bonds, stocks, and bonds? And of course, you can see here, the blue is the yield, the return that you get from S&P 500 stocks. And you can see it's fairly low over the last 20, 30 years or so here. It's been less than 3%, so it's in this lower range. And of course, bonds, since almost all of the income that you get from a bond is returns, bonds have higher returns. So this is the yield of purchasing a corporate bond, the entire return, and then this is just the dividend yield. Excuse me. This is the coupon yield, what you get from interest rates. Again, it's not uncommon to find a bond that will pay 6% or 8% as a coupon yield. So again, the differences is fairly pretty real between the current income. Now what we have to do now is add to this the capital gains piece. The capital gains piece on dividend yield is much higher than what the capital gains piece is typically on corporate bonds. Mm-hmm. So what are the basic characteristics? Again, we talk about equity capital. Equity means ownership. When you buy stock, you're purchasing ownership in the company. Again, that's why it's referred to as equities. Stocks are typically publicly traded issues. That is, you buy them from the general marketplace. You don't have to search out particular investors to buy these from. They're available across the board to anybody that wants to buy them. A public offering is when a corporation wants to issue shares to the public. They want to give the public a chance at becoming an owner in the company. This is what's referred to as a public offering. A rights offering is when a corporation is going to issue new shares, but they're going to give the first chance at these shares to the people that already own the stock. So it's called a rights offering. A current shareholder has the right to buy into this new issue of shares before anybody else in the public. A stock spinoff is when a company takes one of its subsidiaries and converts it into a standalone company, and of course it's going to have shares, or the ownership of that standalone company will be evidenced by shares, and typically they distribute those to the existing shareholders of the current company. A stock split is when a company takes its ownership, and the way I usually try to explain this, if you think about the ownership of the company being a pie, if we had a pie that had 3 pieces in it, that is, we had 3 shares, we could take those 3 pieces and divide each piece by 2. So now we would have 6 shares. But each person then would have 2 of those 6 shares, but you still only have 1/3 of the company. And typically the reason companies split their stock is that they want to keep the price down. They want to make the prices available and attractive to more investors. So shareholders end up with more shares of stock. However, those increased number of shares all have lower prices. So an investor could have 200 shares in a 2-for-1 stock split. They'd get 400 shares. If the stock price was $100 before the split, it would be very close to $50 after the split. So the person still has 400 shares at $50, is $2,000, or 200 shares at the $100, again, was still $2,000. So really, there's nothing happens to the owners. We've just divided the pie into different size pieces. Treasury stock is stock that's been repurchased by the company. For one reason or another, and there's lots of reasons why companies might want to do this, they buy back their shares of stock. And this is a growing trend in companies. Companies are tending to not increase their dividend payouts. They still are probably paying the same kind of dividend, but instead of increasing dividend payouts, they take the cash that they have extra and they use that to buy the stock back. They may be doing that if they think the stock price is too low. So they're buying it back cheap, and if the stock price goes up later, they may be able to reissue it at a higher stock price. In addition, what does the company do with this treasury stock? They could use it for employee stock ownership plans. They could use it for mergers and acquisitions. So there's a variety of strategic strategies. Sorry about that. But there's lots of corporate rationale for why buying treasury stock could be a good idea. The next thing is something called classified stock. And typically this is where a company just issues 2 different kinds of stock. They may have different voting rights. The example they talk about here is the Ford family owns the B shares and everybody else in the world owns the A shares. So the Ford family controls 40% of Ford Motor. So they own almost 50% of the entire Ford Motor Company. So they still have a lot of control over what goes on inside the company. So they could have different voting rights. They might even actually have different payout schedules. But this is just where the company identifies 2 different types of common stock. They're both common stock, but they have different rights, different characteristics. Well, that's the end of part 1 of the common stock chapter.